Okay, individual and stock market risk. In fact, this is what we have been doing to actually try to mitigate. I think there were some questions on margin account. Again, I just want to take it down here very quickly. And the other risk that I just want to highlight here, I realize that there are people who are not very familiar with this risk called the custodian risk. Okay, so basically individual risk, the some of the mitigating action to mitigate like the individual company risk and the market risk is basically diversification. So I think this is just a good refresher. At least 30 stocks in your portfolio, higher better. Buy different stocks over different time and evenly spread as possible. Don't overweight in any particular stock. So I think we have been talking about this all the time. This is just a quick refresher. Then of course, to find the right company, very important. Again, just a refresher, business analysis, financial statement, pricing. Okay, so this is nothing new. Cash management. Okay, so this part I seldom talk about it. Um, so for stocks, right, we talk about only using investable assets, okay, which is money that I can afford to lose. Personally for me, I actually use leftover cash after insurance, and less risky investment. So let's say, for example, I will settle my insurance first, then CPF annuities, whatever left over, then I come and talk about investment. Okay, so hopefully again, this one give you some guidelines as to how do you allocate. So it's really insurance first, then after that, the less risky, then come talk about investment. Okay. The other thing that we may actually want to do, okay, for especially for those who think that market is overvalued right now, which I think is quite close but not there yet. It's good to keep cash. Keep some cash when your opinion market is overvalued or risk of correction is high. I just want to share that now I think there's a euphoria in the market right now that it's like the property it will just keep going up, stock market will just keep going up. Okay, so something we have to take note. I don't think the time is now. Okay, but as we go along, probably along the way, I will also start keeping some cash lah. So that is something we have to take note of. Okay. Yep. So for the other thing that to manage the risk of stock investment is actually to what I call stick to the plan. Again, this one I realize not many people are doing, or either they're not easy to do. So one way is you really have very dedicated portfolio for very dedicated objective. Like to the point, my dividend investing is in one particular brokerage account. It's not that I have one brokerage account doing growth and dividend at the same time. I actually segregate them. So I have dividend stocks in one account with Maybank Kim Eng. I have my growth stock with Lim and Tan, so on and so forth. So it's actually very clear. Okay, very clear. What they call that? Segregation. And you stick to the plan. So long-term investing, you buy and hold, don't be distracted by volatility. As I mentioned always before, like my dividend account, I don't even bother to record my purchase price. Okay, so I'm not distracted by the volatility. So trading, if you actually do trading, okay, you actually cut loss. It's a part and parcel of the game. Options, then be clear of your business plan and stick to it. Like for example, in my case, I'm actually selling insurance. Okay, so I only sell puts, I only sell insurance. So I have a very clear business plan in my options. Okay. Also, the thing I want to put across here is this: you have dedicated like down here basically I have three lah. I have my long-term investing under Maybank Kim Eng. I have my trading under trading. Okay, my growth stock is under Lim and Tan. I do options. Okay, my options is also more into trading lah. So it's actually under Tiger. Okay, so dedicated accounts for dedicated objective, and I stick to my plan. I stick to my plan. I think that is also very important to manage your risks and of course to actually bring across to actually make sure you generate returns. Okay, now I just want to spend a bit of time talking about this. I think there was talks about margin account. So again, I'm not encouraging people to take margin account for stocks. It's just that I want to let you know it's available. Okay, and if you want to take it now, you must know what are the risks for margin account. So margin account is basically borrow money to buy stocks. Okay, so I only do it on REITs. Personally, I only do it on REITs so that the dividend yield can actually cover the interest cost. Okay, so currently it's not really that worth it. When I first started, my interest cost is only about 2.8% or 3%. So if my yield is 6%, I got 3%. The spread is about 3%, very good. So now the interest is about 4.8%. And my yield is still about 6. So the spread is only about 1.2. So not really worth it. But of course, going forward, if you expect interest rate to come down, then may be interesting again. Okay. But this one, the risk management have to be very clear. At least you know what the risks are involved. So I'll just talk about this briefly. So there's actually this thing called margin ratio, whereby you take the total stock value divide by the borrowed amount. Okay, I'll give you a specific example later. You can see clearer later. And once this margin ratio is less than 140%, okay, you are giving 5 days to top up the margin ratio back to 1.4. If the margin ratio go below 130%, right, you have to force sell to pay off the borrowed amount. Okay. So example here, let's say you put $100,000, you can borrow 250,000 to buy 350,000. So the total stock value 350, the borrow amount 250, 140%. Okay, then you're fine. Okay. But if let's say the stock price drop to 30,000, okay, your stock value 30,000, then after that your borrow is 250, then there's a margin call. Okay. So usually what happens here is this, when you go below 140, you'll be called to actually top up, okay, top up the borrow amount. So basically, if you actually top up money, your borrow amount will reduce, margin ratio go up. So if you cannot top up, okay, will start selling your stocks. So basically, your stock value will drop, your borrow amount will drop to the point that it's above 140%. Okay, so that's how the margin account works. So basically, I think now you can open margin account with most of the brokerage firm as well. So again, it's super high risk. Know what you are doing. Like in my case, as I mentioned, I only do it for REITs because why the REITs dividend can actually cover the financing costs. Okay, and I how should I put it? Yeah, I do it over super long term lah. Okay, super long term, so that I am not being affected. Let's say the REITs bankrupt and things like that, I'm actually not being affected very greatly. Okay, so managing margin call risk, basically you have to select the right REITs. Then you have to buy at the right price. Okay, make sure there is sufficient spread. My minimum set is 1.5%. Okay, and you have to keep buffer. So generally now, my margin ratio wouldn't go below 170%. So I wouldn't max up my borrowing. I don't max up my borrowing. I want to keep my margin ratio above 170%. In fact, now I'm doing about 200%, a bit kiasu. Okay, so that is margin risk. Okay. Like I said, now it's not the best time. Probably when the interest rate come down, okay, then I'll talk more about this concept of margin on REITs again. But as it is now, it's not say it's not good. I mean, relatively speaking, I've seen better times. Okay, we will wait for the what do you call that? The rate to come down, then I'll probably just prompt you all again. Okay. Now, there's actually this thing called custodian risk. Okay, some of you may actually have overlooked. Basically, what are custodian? After you buy a stock, somebody have to store the stock for you or to prove that the stock is yours. Okay, in Singapore, which one is the largest custodian for Singapore stocks? Or which is the most official custodian for Singapore stocks? Thank you so much, CDP. CDP. Okay, CDP. Okay, but now of course you have different brokers. Sometimes brokers they actually offer you lower comms. So basically the broker can become the custodian. Okay. So like for example, my Tiger account, okay, my custodian is not CDP, but it's Tiger. Okay. Um and how it works is this: in the eyes of CDP, the stocks belong to Tiger. But Tiger will say, don't worry, the stocks is yours. That means you have to trust the particular brokerage platform. Okay, so now do we have a case whereby this broker actually go bankrupt? Yes. So we have this happened before. This happened in 2011, which is sometimes back. Okay. And this company called MF Global, as you can see, is a broker. Okay, it's a broker. So it actually collapsed. So what I understand here is this, the money that is actually traded or the stocks that is stored them as custodian, right? Okay, is still there. It's still there. Okay, but number one, it will take a very long time to retrieve back because you have to go through all the liquidation procedure, blah, blah, so on and so forth. And number two, okay, they may not actually get back the full amount. Okay, you may not actually get back the full amount. You may only get back partial of it. Also depends on what do they do with the money, or what do they do with stocks. Like for example, there are times whereby, okay, let's say the broker is a custodian, they actually lend out the stocks. Also, there can be issues like this. So, if let's say if your custodian actually collapse, yep, you may not lose all the stocks, but you may not get all the stocks back as well. Okay, and there's a time bomb. So how do you actually make use of this information? Number one, okay, I would suggest if let's say it's for long-term investing, you buy and hold, collect dividend for the next 5 or 10 years, use a CDP, full stop. Okay, or either that the US one use a very very trustworthy custodian. If I'm not wrong, DBS is also one of the custodian. I may be wrong. Okay. But don't use those like fly by night brokerage. I know now that there's quite a few brokering house here and there, or either that at least is MAS approved lah. Okay, MAS approved. That is not so bad. Okay. So for those who actually want to want to save costs and things like that, use a brokerage which is may not be even in Singapore. That one you have to be careful lah. Thank you so much. So DBS Vickers is custodian for overseas stocks. So thank you so much. So things like that. If you want to buy and hold for long term, if you want trading, trading I think is okay. That means you buy today, sell tomorrow. But then then maybe custodian is not so important. Okay. Also, this is something you have to take note. Okay, so with that for the stocks risks, more or less there. So basically, the two things I want to highlight is the margin risk and the custodian risk.